US President Donald Trump's tariffs on imported goods from more than 90 countries take effect from today. In a social media post, President Trump claimed the hike in tariffs are already paying off, with billions of dollars now flowing into the United States. India is facing a 25% tariff rate. This will double to 50% from the 27th of August as President Trump penalizes India for importing oil from Russia. India has strongly pushed back, calling the tariffs unfair and unjustified. Sectors expected to feel the heat include textiles, leather, engineering goods, agriculture, seafood exports. However, certain sectors are exempt. This includes goods targeted under sector-specific duties such as steel and aluminium, pharmaceuticals, semiconductors. India's electronic exports are also exempt at least till the 14th of August as things stand. Brazil has also been slapped with 50% tariffs, with Trump accusing the Lula government of conducting a witch hunt of his old ally, former President Bolsonaro. South Africa, yet another BRICS partner, has been hit with tariffs of 30%. China has been hit with the same rate after it agreed to ease exports of rare earth elements to US. Trump also threatened Russia with tariffs if it doesn't agree to a ceasefire in Ukraine. For Switzerland, the 39% tariff came as a shock as the economy is heavily reliant on exports. Myanmar, Canada, Iraq are also among the countries worst hit by tariffs. In Southeast Asia, Vietnam faces a 20% tariff. Malaysia, Indonesia and the Philippines all have been slapped with a 19% tariff. The EU, Japan, South Korea, among a handful of nations that clinched a deal with the US, they have been hit by 15% tariff each. The UK negotiated a 10% rate. Trump has also turned tariffs into a diplomatic weapon, often announcing major trade decisions via Truth Social rather than through formal channels. Countries like Vietnam, Brazil, South Africa, Canada and Japan were blindsided by sudden tariff hikes, many based on political or ideological motives rather than trade imbalances. Trump also exaggerating India's trade barriers and falsely claiming to broker peace with Pakistan. Experts say Trump's tariff tactics are meant to pressurize countries into last-minute deals that he can brand as victories. Joining us now to take this discussion forward is Brian Coulton, Chief Economist at Fitch. Brian, thank you very much for joining us. Your view now, these tariffs come into effect from today. What's going to be the impact on the global economy? Your latest outlook.
We basically think that this is going to lead to a significant slowdown in global growth over the next year or two, a shock to maybe 1% of global GDP. That's $1 trillion loss in global income as a result of these trade barriers.
Right. Now, about the US itself, how does this really change the image of United States as a place to do business, considering the effective tariff rate against the world in the United States is going up to 17% from 2% last year?
Well, it's obviously massively complicated. Everybody's trading relationship with the US. These barriers are enormous. It's not just the tariff rates themselves, which are huge, highest levels we've seen since the early 1930s. It's also the complexity. You know, every country's got a different tariff rate. I mean, just how they're going to administer this. It's adding massive amounts of bureaucracy to trade as well. But what the US continues to have an advantage, it's an absolutely massive market. The US consumer is the most important market in the world, and that will continue to be the case. And so the rest of the world is just kind of have to kind of take it on the chin. But you know, you don't really have any alternative but to sell stuff to the US, given its position in global markets. But it's going to be a lot more complicated and a lot more costly to do so going forward.
Right. Do you think the US economy is going to benefit from these high tariffs? And what could be the fallout in the coming few months?
No, we don't think the US economy is going to benefit. Quite the contrary. In the near term, we're now forecasting quite a significant slowdown in US economic growth. We've got growth of 1.5% this year and next year. And that comes off the back of an economy that's been performing really, really well over the last 2 or 3 years, growing 2.5%, 3%. So that's not a recession that we're expecting, but it is a pretty significant slowdown. And that's because we think the uncertainty is weighing on business investment. We're already seeing evidence that the consumer is slowing down. We think that will be accelerated in the second half of the year as these tariff increases get passed through to higher prices. That will squeeze real wages. So short term, we see it negative, and we don't see any benefits in the long term either. This supposedly hoped for, rejuvenation of the manufacturing sector in the US economy. I think that's going to be very, very challenging. I don't think tariffs are going to unlock a major increase in the share of manufacturing in US GDP.
Right. And tariffs, once imposed, are always hard to bring down because they bring hundreds of billions in revenue. If these level of tariffs were now to stay, what can happen in the long term in terms of US trading relationships and the impact to the US economy?
You're absolutely right, and we are seeing these higher duties now being collected by the U.S. government, but that's partly expected to be recycled back into the economy next year to fund tax cuts. So, once you've done that, then you do become reliant on that tariff revenue continuing. I do see these tariff rates staying where they are. I think what's happened in the last week or two has kind of, finally put paid to any notion that all these tariff increases were just about a negotiation tactic to achieve other policy goals. That just clearly does not seem to be the case now. This is all about import substitution. The U.S. administration trying to turn the U.S. economy into a producer-driven economy, trying to switch U.S. consumption away from imports and towards domestic production. If that's the goal, then and tariffs are seen as the tool in which to achieve that goal, it's pretty clear that these barriers are here to stay. So I think that trend of globalization that we saw all the way up until about 2015. Since then, it's kind of been steady in terms of the share of global exports of goods and services as a share of global GDP. I think there's got to be a very good chance that starts to reverse in the next 3, 4, 5 years. We'll see global trade shrink as a share of GDP again, as every economy starts to become more closed and more self-sufficient, particularly the US.
Right. I would also like to ask you about India. How do you think this tariff, 25% last week, and now an additional 25%, which comes into effect on the 27th of August, if this hit had to happen, a 50% tariff, how would this change your outlook on India?
Yeah, it's a big shock, particularly relative to the sort of earlier expectations that India would quickly come to achieving a bilateral trade deal with the US. If you think back to the debate back in March and April, that was very much the consensus that there would be a US-India trade deal would be quite easy to achieve, and India had kind of access to a huge domestic market as a carrot for the US, and the US was looking, really had something to gain, and therefore India would have leverage. Well, hasn't panned out that way, so it's obviously a big disappointment. And these are quite significant numbers. India exports $88 billion of exports to the US, so a 50% tariff rate on that, even allowing for the carve-outs, is a big number, but it's probably a manageable shock, I would say. So if you look at the increase in the tariff rate, if you assume that the mix of India's exports to the US stays the same and the volume stays the same, that we're talking about an extra hit of 0.7% of Indian GDP. So it's a big number. It's not clear that would all be borne by the Indian economy, but it's a big number. If it's 25%, it's 0.4%. If it's 50%, it's 0.7% GDP. That's a decent sized figure, but it's kind of manageable. I don't think it's going to push the Indian economy into a deep slowdown, but I do think it's going to have a negative impact on confidence. And the upside that people were talking about in India from gaining market share from, say, China in the electronics markets, that upside has definitely gone. So I think the sentiment impacts could actually be quite significant.
Right. Finally, the crude oil bill. How do you think India's crude oil bill is likely to spike? Because our energy imports, our oil imports from the US are going to spike 150% as per sources in the government.
Yeah, I mean, obviously, if you go back to 2022, 23, 24, what was going on was that there was this huge discount between the oil price charged by Russia to Indian importers, a big surge in Indian imports of crude oil to a peak of about 2 million barrels a day, I think, from Russia. And for those early years, 22, 23, 24, there was a really sizable discount on the global price. And so that was saving India a lot of money. But that discount has got much smaller in the last couple of years. So again, it's the number we're talking billions of dollars, but it's not something that I think is going to have a massive impact. I think maybe the bigger risk for India may be Trump's efforts to sort of stop other countries buying Russian oil. If he's successful in managing to limit the supplies of Russian oil to the market, that could be a broader upside pressure on global oil prices. Because one of the interesting developments since the Russia-Ukraine war is that Russian oil did not leave the market. It just got redirected, and that prevented oil prices from rising faster. But if oil prices go up, India is one of the most vulnerable economies to an oil price hike. Net oil imports are 4.5-5% of GDP, so it's very exposed to an increase in global oil prices. So I think that might be more of a risk than the direct effect of losing this discount by switching from Russian to US oil imports.
Right. Thank you so much, Brian Coulton, for joining us on the program. Let's move on. In all